The U.S. stock market just experienced one of its most brutal weeks of the year, and the timing could not be more confusing for the average investor. We just received inflation data that, on the surface, looks like exactly what the Federal Reserve has been waiting for. Core inflation is cooling. Yet, instead of celebrating, Wall Street is hitting the sell button. The S&P 500 just closed at its lowest level of 2026. The Dow Jones Industrial Average and the tech-heavy Nasdaq Composite are both bleeding. And all of this is happening just days before the most critical Federal Reserve meeting of the quarter. Welcome to Market Brief. We do not do hype and we do not do panic. We look at the data, we analyze the trends, and we explain exactly what is moving the markets so you can make informed decisions. Today, we are breaking down the massive disconnect between the latest economic data and the stock market's negative reaction. We will look at the hidden geopolitical fears driving oil prices up 47%, the surprising GDP revision that has economists worried, and exactly what Jerome Powell and the Federal Reserve are likely to do this Wednesday. If you want to understand why your portfolio is in the red despite good inflation news, you are in the right place. Let us get into it. Let us start with the data that was supposed to save the market this week, the February Consumer Price Index, or CPI. The Bureau of Labor Statistics released this report on Wednesday, and initially, it looked like a victory lap for the Federal Reserve. The headline CPI number came in at a 0.3% increase month over month. That keeps the annual inflation rate steady at 2.4%. But as we always say on this channel, the headline number is just noise. The real story, the number the Fed actually cares about, is the core CPI. Core CPI strips out the highly volatile categories of food and energy. It gives us a much clearer picture of the underlying sticky inflation in the economy. And this is where we saw significant, undeniable progress. Core inflation rose just 0.2% for the month, bringing the year-over-year number down to 2.5%. To put that 2.5% in perspective, that is a massive improvement from where we were a year ago, and it is inching incredibly close to the Federal Reserve's ultimate target of 2%. By all traditional macroeconomic logic, a cooling core CPI means the Fed's aggressive interest rate hikes have worked. It means they can finally take their foot off the brake. But when we look under the hood of the CPI report, we start to see why the market is not throwing a party. While core CPI is down, the things that everyday Americans actually buy are still going up. The shelter index, which measures housing and rent costs, rose by 0.2%. The food index saw a 0.4% increase for the month, pushing its annual increase to 3.1%. And then there is energy. The energy index spiked by 0.6% in a single month. This is the canary in the coal mine. While the Fed likes to look at core inflation to set policy, consumers live in the headline inflation world. They pay for gas and they pay for groceries. And right now, those costs are accelerating again. This brings us to the real reason the stock market is selling off. If inflation is generally cooling, why did the S&P 500 drop 2.4% this week to close at 6,632? Why did the Dow lose nearly 2% and the Nasdaq drop 1.2%? The reality is that the market is no longer just trading on inflation data. It is trading on a toxic combination of geopolitical fear and slowing economic growth. Let us talk about the geopolitical situation first because it is the elephant in the room. Escalating conflicts in the Middle East, specifically involving U.S. and Israeli forces against Iran, have led to severe disruptions in the Strait of Hormuz. For those who do not track global shipping routes, the Strait of Hormuz is arguably the most critical choke point for global oil and liquefied natural gas supplies. When shipping is threatened there, energy prices do not just tick up, they explode. Since the end of February, crude oil prices have surged by a staggering 47%. West Texas Intermediate crude is now sitting near $99 a barrel, and Brent Crude, the global benchmark, has breached $103 a barrel. This is a nightmare scenario for the stock market. High oil prices act as a direct tax on consumers and corporations. It eats into profit margins, it reduces discretionary spending, and worst of all, it threatens to reignite the very inflation the Fed has spent the last 3 years trying to kill. But expensive oil is only half the problem. The other half is economic growth. Just days ago, the Bureau of Economic Analysis quietly released a massive revision to the U.S. gross domestic product, or GDP, for the fourth quarter of 2025. Initially, they estimated the economy grew at a sluggish but acceptable 1.4%. The revised number? A mere 0.7%. That is a massive downward revision. It brings the total economic growth for 2025 down to 2.1%, a sharp deceleration from the 2.8% growth we saw in 2024. So, put yourself in the shoes of a Wall Street portfolio manager. You are looking at an economy that is slowing down faster than expected, while energy prices are skyrocketing due to war. This is the textbook definition of stagflation risk. Stagnant growth combined with rising prices. That is why the market is selling off. Investors are taking their chips off the table because the macroeconomic picture just got significantly darker. Now, it is not all doom and gloom. If you look closely at the market internals, there is a massive divergence happening between the broader economy and the technology sector. While the Dow and the S&P 500 are hitting their lowest levels of the year, big tech, specifically the Magnificent Seven, is actually holding up remarkably well. In fact, on Monday, while the rest of the market was struggling, these tech giants were flashing green. Nvidia continues to defy gravity. The stock jumped 2.2% to close at $184.25. The catalyst here is the massive anticipation surrounding their new Rubin GPU platform, which promises to push artificial intelligence capabilities even further. Meta saw its shares rise 1.9%, closing above $625. Tesla, Amazon, and Microsoft all posted gains near 1%. Even Alphabet managed to close in the green. What this tells us is that in times of macroeconomic uncertainty, investors are treating megacap technology stocks as a safe haven. They are betting that the artificial intelligence revolution is a secular trend that will continue to drive massive revenue growth, regardless of what happens with oil prices or GDP. We also have to acknowledge that corporate earnings, broadly speaking, have been a bright spot. With the majority of companies having reported their Q4 2025 results, S&P 500 earnings have actually shown strong growth of 13.6%, backed by a 9.2% increase in revenues. Companies are making money. The problem is that the stock market is a forward-looking mechanism. It does not care what you earned yesterday. It cares what you will earn tomorrow in a world with $100 oil and sub-1% GDP growth. This brings us to the most important event of the month, and perhaps the quarter. This Tuesday and Wednesday, March 17th and 18th, the Federal Open Market Committee will hold its policy meeting. Let me save you the suspense. The Federal Reserve is not going to cut interest rates this week. If you look at the CME FedWatch tool, which tracks the futures market to gauge investor expectations, there is currently a 99.1% probability that the Fed will hold rates exactly where they are, in the 3.50 to 3.75% range. Just 1 month ago, there was a nearly 10% chance of a rate cut priced into the market. Today, that chance has evaporated to less than 1%. The market has completely surrendered the idea of cheap money coming anytime soon. But if the rate decision is already decided, why does this meeting matter? Because of the communication. On Wednesday afternoon, Jerome Powell will step up to the podium for his press conference, and the Fed will release its updated dot plot, the chart that shows exactly where Fed officials expect interest rates to be at the end of the year. Analysts are currently pricing in 3 potential scenarios for Powell's tone. The most likely scenario, with about a 60% probability, is a neutral hold. Powell will acknowledge that core CPI is improving, but he will point to the geopolitical risks and rising oil prices as reasons to remain cautious. He will say the Fed is data dependent. If this happens, expect the market to remain choppy and volatile. The second scenario, with a 25% probability, is a dovish hold. Powell hints that despite the oil spike, the underlying economy is slowing enough that rate cuts are definitely coming later in 2026. If he says this, the stock market will likely rally hard. The final scenario, with a 15% probability, is a hawkish hold. Powell focuses heavily on the energy spike and the risk of inflation returning, signaling that rates might stay high for the entirety of 2026. If we get a hawkish hold, the current market sell-off will accelerate rapidly. Beyond the Fed, we also have some critical earnings reports this week that will give us a real-time look at the health of the consumer and the global supply chain. On Wednesday, we will hear from General Mills. This is a pure play on the American consumer's grocery budget. Are people trading down to cheaper brands? Are they buying less volume? General Mills will tell us. On Thursday, we get reports from Accenture and FedEx. FedEx is particularly important. As a global logistics giant, their earnings and forward guidance are often viewed as a proxy for the broader global economy. If FedEx warns about slowing shipping volumes, it will validate the fears of a slowing GDP. The bottom line for this week is patience. The market is repricing risk. It is digesting the reality of higher oil prices, slower growth, and a Federal Reserve that is in no rush to rescue investors with rate cuts. Until we hear from Jerome Powell on Wednesday afternoon, expect the volatility to continue. Do not try to front-run the Fed. We will be back on Thursday with a full, comprehensive breakdown of the Fed's decision, what Powell actually said, and how the market is reacting. We will cut through the noise and give you the exact data you need to know. If you appreciate clear, organized market analysis without the hype, make sure to hit the subscribe button and turn on notifications. Thank you for watching Market Brief. We will see you next time.